Today on The Real Deal, we decode India's first REIT IPO, the Embassy Office Park REITs IPO, sponsored by Blackstone and the Embassy Group. This is subscription today. This REIT worth investing in? What experts to answer these very important questions? Let's get you the basics. My colleague Sonal Bhutra has put together.
Thanks a lot, Shah. And yes, the investors are getting a new investment trust. But what is something like an office building to real estate as the underlying asset? The minimum investment rules is 2 lakh rupees in a REIT, receives from unit holders, completed and revenue generating assets, properties, debt of the real estate sector. But now let's move on to the much spoken about REIT by the Embassy Group that opened today. The company is planning to raise around 4,750 crore rupees via 158.6 million units priced at 299 to 300 rupees per unit. Rough calculations indicate this price to be at a 10 to 15% discount to the net asset value. The proceeds will be used to pay debt and also to buy some more assets. Discussions with experts suggested that REIT could give a yield of around 7 to 8%. The total portfolio of this particular REIT is valued at 32,000 crore rupees, out of which there is a leasable area spread over 32.7 million square feet, and there are also 4 hotels, 2 of which are completed and remaining are under construction. Additionally, Embassy will also take a loan of around 4,000 crore rupees to fund further construction of properties, and also they will be reducing some debt. The current debt is around 7,600 crore rupees. Now to the main question which a lot of investors must be wondering. What about the taxation? If you are a unit holder in a REIT, how will you be taxed on the interest and the dividend that you earn? So for starters, interest from SPV is treated as interest income, and REIT has to deduct withholding tax on the same, which is 5% for non-resident Indians and 10% for domestic investors. Dividend, that is exempt from tax, as REIT has got the pass-through status on the rental income in the budget of 2015. And if you sell the units after a point in time, capital gains shall be charged on the same. While LTCG, that is long-term capital gains, is exempt, short-term capital gains is taxed at 15%. And lastly, for this particular subscription, you have to minimum invest around 2.4 lakh rupees. And that is the minimum amount that you will be investing. And it will be very interesting to see the retail participation, as big investors like Radhakishan Damani has already invested as an anchor investor. So very interesting times for real estate sector going ahead. Back to you.
Sonal, thank you very much. And of course, lots of tax implications, but we will sum it up to you. I mean, I'm guessing that everyone wants to know what is the end tax that I will have to pay. The other interesting aspect of this REIT has been the assets it owns. It's 32.7 million square feet of 7 global quality office parks, fastest growing cities, Bengaluru, Pune, Mumbai, Noida. And a very, very marquee list of clients. You have Morgan Stanley, Google, Microsoft, Accenture, PwC, Rolls-Royce. That's half the portfolio is rented out to Fortune 500 companies on an average lease of about 7 years. Looks great, but these are the questions which have come from the experts and of course some of the people who have written to us on Twitter as well. Let us get in the views of Sameer Jasuja, co-founder of Prop Equity, Arvind Nandan, executive director of research at Knight Frank, and Madhav Poddar of EY. All right, I'm going to just go on to the first Twitter question. This is Gagan Maheshwari. He's asking us what is the rate of return he can expect annually. So Sonal did say, Sameer, that you can expect between 7 to 8% post-tax returns. Is that the number you're looking at in the first year as well?
Yes, we're expecting around 7.5% rental yield or dividend payments going in the hands of the consumers or subscribers. But we do also anticipate a significant amount of capital appreciation that this REIT is particularly going to witness over the next 2 to 3 years, because as mentioned, 20% of the assets in this REIT are under construction, and they are in excellent IT parks, the demand of which is huge. The rentals are going up in those areas. So that effect will also provide a significant opportunity for capital appreciation, which we're anticipating in addition to the 7.5% by about 7% annualized.
Sameer, what I've read is that it's 8.5% is what is indicated. Then there is 15% tax, which brings it down to about 7.23%. Then in year 2, you can look at a growth of up to 9.25%. 15% taxation means 7.86%. Would you also build in anything at all for capital value appreciation of the underlying assets, or not just yet?
Yeah, that's what I actually said, that the 20% of the portfolio consists of under construction properties where the return is going to be much higher, and that will lead to an additional capital appreciation of this unit by about, I can anticipate, between 5 to 8% on an annualized basis. In addition to that, over a 2 to 3 year period, there are going to be a lot of lease rentals in this portfolio that are going to come up for renewal, and roughly about at a 15% increase every 3 years. That will also translate to an additional 1 or 2% on the annualized yield curve. So overall, I think this asset class for the consumer to invest in is an excellent one. The next 3 years is going to witness a substantial amount of commercial demand, as we see today. There's going to be no slowdown, especially in the cities that Embassy REIT is operating out of, whether it's Bangalore, Mumbai, Pune, or even Noida. They have excellent high-grade, A-quality assets. So I think,
right.
you know,
let me
all
get
looking very good
Arvind
from
here.
that point.
Arvind. Okay, all looking very good, Arvind. There must be some risk factors. So my first question is, would you agree with Samir that you could look at returns in early teens, at least 12 to 13%, if you club what get as rental yield plus capital appreciation? And are there any worries that the commercial cycle has topped out and probably going forward from here, you could see some pressure on the yields at all?
Manisha, two things. First of all, I do agree with Samir. Even if it is not in early teens, it's definitely, 10, 11% for sure. If you club the rental yields as well as the capital appreciation. So that is one. The other thing is, the pressure on rentals is practically not visible right now. If at all, the rentals look to firm up even further, and there is an underlying reality. We've seen in the last year, in 2018, that while the residential sector was under pressure, commercial has been just going up and up. Coupled with the fact that in Bangalore particularly, and in many other cities, the vacancy rates have been significantly low. Bangalore is actually, 5% or lower. Now, with that kind of a situation, you don't see the pressure on rentals building up anytime soon, not at least in the next 2-3 years. So all in all, if you look at all these things together, I think the timing is very good, and it should get, investors the yield or the kind of appreciation that we've been speaking of right now.
All right, let's take this other question. We've got one from Avinash on Twitter. He wants to know what are the risks of investing in this kind of business? Because, Samir, this is really not a pure debt play at all. There are risks associated with investing in REIT as well. Can you outline some so that, people go into it with their eyes open?
You see, the predominant risks that have been seen in REITs, especially the ones that came out of India, whether it was the India Bulls REIT in Singapore or the Unitech REIT in London, those REIT yielding assets actually didn't give out the returns that they promised to the end user or the end buyer over here in this case. However, I don't feel that risk over here, because Blackstone is involved, and that's a very important thing to keep in mind, which is one of the largest private equity funds in the world, and that is super blue chip in my mind, and they will ensure all kind of transparency and ethical standards that will be maintained. So that's one risk mitigated, and that's the biggest risk. The promoter risk is the biggest risk, which is getting mitigated through Blackstone. The second big risk, of course, is the economy taking a downturn, which in my view is a very limited risk as such, and the IT sector going through a downturn, which at least for the next 1 year can't be foreseen. Given Blackstone having a 55% share in this vehicle, I would say most of the risks do get mitigated because of huge capital infusion capability from Blackstone should things go wrong. And also, one thing that has to be, REIT has hospitality assets. Now, that could have been considered a risk, but as we all know, the hospitality sector is also now turning around, and people are saying that it's going to start reaching a year high in the coming 2019 to 2020 with respect to hospitality demand. So At this point in time, I don't foresee any risks for the next 1 or 2 years, especially with respect to this particular REIT. We'll have to look at on a case-to-case basis as and when come into the market as to what risks are going to be with respect to each REIT that comes into the market. This one seems to be pretty safe.
You're answering some important questions that retail investors have to make up their minds whether they should take a plunge into this investment or not. Arvind Nandan, I'm going to come back to you. There is a question which came to us on mail asking, what is this investment closer to? Is it closer to a debt investment or is it closer to an equity investment? It's difficult for people to understand because, right now they bracket most investments into these two buckets.
Well, yes, that's the usual confusion that people will have. And first, we must go into definitions, before we answer that. Globally, you either have mortgage REITs or equity REITs. We must understand that we are not doing mortgage REITs here. These are, going to hold direct assets. But having said that, I had actually said a couple of days ago that, you got to look at it very closely as you look at a mutual fund investment. The only difference being that the REIT is actually going to hold through an agency or an SPV, the direct assets, while the mutual funds don't hold those assets. But you should still look at them closely as you look at the mutual funds. Now, the basic difference or the basic trouble could come from the fact that, which Samir also highlighted just a little while ago, that, 49% of the underlying assets here are, the technology or the IT companies. And you could raise a question on, if those companies start going down or if the rentals don't come from those sectors, then what happens? I think it's a fairly preposterous question as of now, because more or less, these industries, these companies are doing extremely well. I would say you look at it less as a high-risk investment, look at it more as a safer, more assured investment. So if you want, if you will, you may want to look at it like you invest in a debt, although it's not exactly a debt. I don't know if I answered that, but I think that's how you got to look at it.
All right. More debt. Okay, Samir, would you agree that, because REIT has 80% of its assets in completed and income-producing properties, it has elements of both, but definitely regular and growing cash yields, which are more certain, puts it closer to debt than equity?
Yes, I would tend to agree with that point, that I think this is more debt-like, although the underlying asset is equity, but because it's a rent-generating asset and hard assets underlying the REIT, I think this more sounds like or feels like a debt-yielding asset, and I would actually call it more like a fixed deposit kind of instrument more than even debt, for that matter, because once the debt gets paid off in this REIT, and that's what the money is being raised for, it's really holding a great real estate asset that is income generating, that's over 93% leased. The demand with respect to those cities is higher than the supply today. The assets are world class, and I just think that this is you should look at it investing into a fixed deposit kind of an instrument with a much better return than a fixed deposit as such. And the biggest safety factor for me is that BLACKSTONE owns 55%, and I reiterate that.
Risky call. No, you've said that, Samir, but I think, let's not call it very close to FD yet, but I appreciate your views and the explanation. Okay, there's one more Twitter question that we've got. One of the ladies says that why are the present IRB and IndiGrid InvITs faring so poorly? Is there a possibility that REITs will also or could also, fare poorly? Now, this is a question that I think a retail investor has, and it's an important one. Arvind, would you like to take that question?
Yeah, it's ideally, you need a very detailed explanation for understanding this, but I'll try and keep it short. Most of our infrastructure investment trusts haven't been able to give that kind of return because of a variety of reasons. When I look at the REIT that has come up, and we have only one right now, I think the basics are all in place. It holds the right kind of assets which are already income generating. Samir said just now, you also said it, already income generating. So there is no uncertainty on their ability to produce income. Another 20% is under development with all the blue chip companies hopefully lined up there as well. You have a very good mix of assets. You know, it's only about 49% of offices. You have 1,096 keys of hotels. You have food courts, and you have certain other assets. So the mix is right. They're already income producing, and therefore, and the biggest, I would say the biggest thing is the hurdle that was there 3 years ago was that of the dividend distribution tax, which fortunately is not there anymore. So something which could have eroded the yields in the hands of investors has also been removed. I do not see, a fear of the type that infrastructure investment trusts had, or you had with infrastructure investment trusts, because they were playing in a very different manner. And the REIT that has now come up, and hopefully more that will come up, are going to play in a very different kind of a terrain.
All right. Samir, would you agree with that, REITs and InvITs are very different? REITs own buildings in perpetuity, rentals are growing under contract, and then InvITs actually have few road concessions which have fixed life. So these are actually very different products. It's like comparing oranges to apple.
Absolutely correct. I wouldn't agree with you more and with Arvind. I think, with respect to this particular REIT, and I reiterate this again and again because I want the viewers to know that they have to be very careful when they choose REITs, when more REITs come into the market. These commercial assets, and when we are in a commercial upturn in the market where demand is much higher than the supply currently, especially in the cities that this REIT is operating out of, those factors make this instrument or this kind of an asset class very different from the infrastructure REITs, which have huge problems coming from every area. And this REIT, particularly in the commercial asset classes, are kind of risk mitigated in most of the ways in the current environment. So that's very important to look at as to what kind of REIT it is, which asset class is it operating in, which vertical, who's behind that REIT, whether the 80% of the assets are income yielding already and from whom, and which cities the underlying assets are in, are all factors that have to be kept in mind before choosing the right product over here, I would say.
Okay. All right. Seems it's a go-ahead from both of you. You're both very bullish about this REIT IPO. Arvind Nandan and Samir Jasuja, thank you very much for joining me. Well, most experts we spoke to this morning are also betting on the quality of assets in the Embassy REIT portfolio and its lease rental potential. Here are some of the key takeaways from that conversation we had in the morning with the experts.
We've seen the commercial demand over the last few years at 30 million square feet. Across the country. At 30 million square feet, India market is the highest absorption market in the world. If you look at rentals today in Bangalore, most of Embassy's, around 60% of the portfolio is in Bangalore. Bangalore vacancy today is at 3%. Anything less than 10% is considered extremely healthy. Bangalore rentals today, average rentals between $12 to $14. Comparable markets, Singapore at $90, Shanghai at $85. Again, a fantastic story. And the best thing is, I think, the sponsors, which is both Embassy and Blackstone. I would definitely rate Embassy amongst the top 10 developers in the country.
I believe that the REIT structure would be more of a fixed income plus kind of an instrument, because the underlying rentals from this portfolio will be steady over a period of time. There will be variability in terms of the market cycle, because at the end of the day, rentals in offices are very closely linked to the business cycle. But given that this is a diversified portfolio, there will be some stability in the underlying rentals.
The commercial real estate market has troughed out. The rentals are stable, they are growing. The vacancies are much lower across India. The new asset classes, the new buildings which are there in the hands of other institutional investors and not really in the developer. So it is a great instrument for a liquidity event for a developer. It is a liquidity event for the foreign institutional investor who has invested for 10 years plus in this market. I clearly feel that participation by the ultra HNI and institutions is going to create a market making situation for this particular instrument. And you will see it is a beginning. I clearly feel that this year you would have at least one or two or maybe a couple of more would be planning to do the similar kind of thing to expand the market.
Well, most of the experts seem to be very positive about the REIT. We're going to wrap out now from this edition of The Real Deal. More's coming up.